Imagine a company that discovers a way to increase its output without increasing its workforce. It can write software faster, analyze financial data faster, answer customers faster, create marketing campaigns faster, process documents in minutes instead of hours. And suddenly, every employee can accomplish far more than they could before. For the company, this sounds like almost everything it could want. Higher productivity, lower costs, faster growth, potentially higher profits. But then comes the strange part. If every employee becomes more productive, does the company still need as many employees? That's the question sitting underneath the artificial intelligence boom. Companies around the world are investing enormous amounts of money into AI because they believe it can fundamentally change how work gets done. And AI really can increase productivity. But that creates a paradox. The technology that helps companies grow may also reduce the number of additional workers they need to hire. And that doesn't necessarily mean millions of people suddenly get fired. The change could be much quieter. A company might simply stop replacing every employee who leaves. It might hire 50 people instead of 100. It might discover that a team that once required 10 people can accomplish the same workload with 7. The company continues growing. Revenue increases. Profits increase. But employment doesn't necessarily increase at the same rate. And that raises a much bigger economic question. What happens when economic growth no longer requires proportionally more human workers? To understand that possibility, we first need to understand what companies are actually buying when they invest in AI. They're not simply buying software. They're buying productivity. For most of economic history, businesses have looked for ways to produce more with fewer resources. Factories introduced machines. Offices introduced computers. Businesses adopted spreadsheets, databases, the internet, cloud computing, and automation. Every major technological improvement changed the amount of work one person could accomplish. AI is the latest step in that process. But unlike many previous technologies, AI is moving directly into tasks that once depended heavily on human cognitive labor. A software developer can ask AI to generate code, identify bugs, and explain technical problems. A financial analyst can use it to process enormous amounts of information. A customer service employee can use it to handle routine questions. A marketer can generate ideas, analyze campaigns, and produce content much faster. An office employee can automate repetitive administrative tasks. And the important point is that the employee doesn't necessarily disappear. Instead, the employee becomes more productive. Imagine a company with 100 employees. Before AI, those workers collectively produce $10 million worth of annual output. Now, suppose AI tools allow the same 100 people to produce $13 million worth of output. The company has just increased its productive capacity without hiring another person. That's extremely valuable, but it creates the next question. What happens if the company doesn't actually need all 100 employees to produce what customers demand? That's where productivity begins to affect employment. Let's take that example one step further. Imagine the company originally had 100 employees producing $10 million in annual output. After adopting AI, those same workers can produce $13 million. But suppose customers only demand $11 million worth of output. The company now has excess productive capacity. It doesn't necessarily need to hire more workers. In fact, it might discover that 90 employees can produce everything customers currently want. So the company has a choice. It could keep all 100 employees and use the additional capacity to pursue new business. Or it could allow the workforce to shrink naturally through resignations, retirements, and normal turnover. Nobody has to announce. AI has replaced 10 employees. The company might simply replace fewer people when workers leave. This distinction is extremely important because when people imagine automation, they often picture a dramatic event. A machine arrives. Workers are fired. Jobs disappear. But technological change doesn't always happen that way. Sometimes it happens through hiring decisions. A company that once needed 100 new employees to support expansion might now need only 70. Another company might grow its revenue by 20% while increasing its workforce by just 5%. And another might keep its workforce almost unchanged while dramatically increasing output. From the company's perspective, this can make perfect financial sense. Businesses don't hire people simply because they are growing. They hire people when the expected value of another employee is greater than the cost of employing that person. If AI increases the amount of work each employee can perform, that calculation changes. And this creates one of the most important potential shifts in the labor market. Companies may be able to grow without creating jobs at the same rate they once did. That doesn't mean AI automatically causes mass unemployment. It means the relationship between economic growth and employment could become weaker. And if that happens, the impact won't be evenly distributed, because not every job consists of tasks that AI can perform equally well. This is where the phrase, AI is taking jobs, becomes too simplistic. A job is rarely one single task. It's usually a collection of different tasks. A financial analyst might gather information, build models, interpret results, and explain recommendations to clients. A lawyer might research documents, draft contracts, negotiate with clients, and argue cases. A software developer might write code, but also understand what the customer actually needs and make decisions about how a system should work. AI may be excellent at some of those tasks. It may be much less capable at others. So the first impact of AI may not be the disappearance of entire professions. It may be the restructuring of those professions. A customer service department might still need human employees. But if AI can answer thousands of routine questions, those employees may spend more time dealing with difficult cases. A marketing team may still exist, but AI might eliminate hours of research, drafting, and basic content production. A software company may still need programmers, but each programmer may be capable of handling significantly more code. In other words, AI can replace parts of jobs without replacing entire occupations. And that creates an unusual outcome. Some workers become more productive and therefore potentially more valuable. Others perform tasks that are increasingly easy to automate. The difference could become enormous. But there's an even deeper problem. When AI takes over the easiest tasks in a profession, it can also remove the tasks that traditionally helped inexperienced workers learn. And that brings us to one of the biggest hidden consequences of the AI revolution. An entry-level job is more than a paycheck. It's often the first step on a career ladder. A junior analyst learns how financial analysis works. A junior programmer learns how real software is developed. A young lawyer learns how to research cases. A new employee makes mistakes, receives feedback, and gradually becomes more valuable. Companies traditionally accepted this learning process because junior employees could perform simpler tasks while developing their skills. But AI could change that calculation. Imagine a consulting firm that previously hired 100 junior analysts. Those analysts spent their first few years collecting information, preparing spreadsheets, summarizing documents, and producing basic reports. Now, imagine AI can automate a large portion of that work. The company may still need experienced analysts. It may even become more profitable. But perhaps it only hires 50 junior analysts instead of 100. There doesn't need to be a mass layoff. The change happens through fewer opportunities at the bottom of the career ladder. And that's potentially much more important than it sounds. Because if fewer young workers get the opportunity to perform basic tasks, fewer workers may develop the experience needed for senior positions later. AI could therefore create a strange paradox. Experienced workers become more productive, while inexperienced workers find it harder to become experienced. But this doesn't mean the future is automatically bleak. Technology has repeatedly destroyed some forms of work while creating entirely new industries and occupations. The automobile eliminated some jobs, but created others. Computers eliminated certain forms of clerical work while creating entire technology industries. AI could do something similar. The question is whether new opportunities will appear quickly enough and at a large enough scale to replace the opportunities that disappear. And even if they do, There's another question that matters enormously to investors and workers alike. If AI makes companies much richer, who actually receives that new wealth? This may be the most important financial question in the entire AI story, because productivity is not the same thing as prosperity. Suppose AI allows a company to produce 20% more output with roughly the same workforce. Where does that additional economic value go? The company could lower prices and attract more customers. It could invest the additional profits into expansion. It could increase employee compensation. It could return more money to shareholders. It could acquire other businesses, or it could do several of these things at once. The technology itself doesn't decide. The economic system does. And this matters because AI could change the balance between labor and capital. If software, data, computing infrastructure, and intellectual property allow a company to produce more while requiring fewer workers, the owners of those assets could capture a larger share of the resulting wealth. That could mean higher corporate profits, potentially higher stock valuations, greater returns for investors, and possibly higher compensation for workers whose skills complement AI. But it could also create pressure on workers whose tasks are becoming easier to automate. This is where AI intersects with one of the oldest economic debates. When technology makes production more efficient, who captures the productivity gains? If the gains are broadly distributed, AI could raise living standards. Companies become more efficient. Products become cheaper. Workers become more productive. New businesses emerge. But if the gains become highly concentrated, AI could increase the gap between people who own productive assets and people whose income depends primarily on selling their labor. And that brings us to perhaps the most important distinction of all. The future labor market may not simply be divided between people with jobs and people without them. It may be divided between people who can leverage AI and people whose tasks AI can perform. Imagine two workers with similar levels of experience. The first uses AI to research faster, automate repetitive work, analyze more information, and test more ideas. Instead of competing against the machine, that worker uses it as leverage. The second worker performs tasks that AI can increasingly complete on its own. The company now has a financial reason to automate part of that work. Same technology, same economy, completely different outcomes. This is why the AI revolution could create enormous opportunities at the same time that it creates disruption. A small business owner who once needed 5 employees might eventually operate with 3 highly productive people and a collection of AI systems. That could make entrepreneurship cheaper. It could allow smaller companies to compete with larger organizations. It could create businesses that would have been impossible to operate before. And for individual workers, AI could become a form of leverage. One person might be able to accomplish what previously required an entire team. But the opposite is also possible. If a worker's main value comes from performing routine tasks that software can automate, the economic value of that labor could decline. That's why the most valuable skill of the AI era may not simply be knowing how to use one particular AI tool. Tools will change. Models will improve. Software will become easier to use. The more durable advantage may be knowing what questions to ask, what decisions to make, what information matters, and when the machine is wrong. In other words, AI may increase the value of human judgment precisely because machines are becoming better at generating information. So the question for workers isn't simply, will AI take my job? A better question is, which parts of my job are becoming automated? And what valuable work remains? Because the workers who answer that question early may have a significant advantage. But this still leaves us with the biggest question of all. If AI can make companies more productive, if it can generate enormous amounts of new wealth, and if fewer workers are required to produce that wealth, can an economy continue to create broadly shared prosperity when economic growth no longer requires proportionally more human labor? And perhaps that's the question we should have been asking all along. The future of AI isn't simply a story about machines taking jobs. It's a story about what happens when companies can create more economic value without needing proportionally more human labor. That could produce enormous benefits. AI could make businesses more efficient, lower the cost of services, create new industries, make small companies more competitive, and give individual workers capabilities that were once available only to large organizations. But those benefits aren't guaranteed to reach everyone equally. Some workers may become dramatically more valuable. Others may see their tasks automated. And an entire generation of young workers could face a more difficult path into professions if companies need fewer entry-level employees. At the same time, investors and business owners could benefit enormously if AI causes productivity and corporate profits to rise. So the real debate isn't whether AI is good or bad. It's about who captures the productivity gains. If one worker with AI can produce what 3 workers once produced, society has gained enormous productive capacity. But what happens to the other 2 workers? Do they move into new industries? Do new businesses create new demand for their skills? Do wages rise? Do companies invest their higher profits into expansion? Or does more of the wealth simply flow toward the owners of capital? We don't know the final answer yet. And that's important, because technological revolutions rarely produce simple outcomes. They destroy some forms of work, create others, change entire industries, and force workers to adapt. AI could do the same thing, only potentially much faster. So perhaps the biggest economic question of the AI era isn't, will AI replace humans? It's this. If AI makes every worker more productive, will that productivity create a better economy for everyone, or simply a more profitable economy for the people who own the machines? Because if companies can grow faster without hiring proportionally more people, we may be entering an economy where growth and employment are no longer as tightly connected as they once were. And that could change everything, not just the future of work, but the future of wealth, markets, money, the decisions behind wealth.